Hello, David and Tom Moore, Equity Advantage. Once again, I'm happy to have my brother here with me in the studio today. And Tom, we just wanted to sort of hear from your perspective. You're on the operations side. You're really in on the deals that are happening. What kind of trends do you see going on right now? What do you see our clients doing? And sort of what's the catalyst for those actions too?
I think more so now than ever before, we're seeing people that are moving their investments across state lines. It just seems to be more and more common all the time. People get concerned with the rent control that's happening in certain cities, and they just feel like they're losing control of their assets. They don't have the rights as a property owner, as a landlord that they want to have or that they once had. So they're moving to states that maybe are a little bit more landlord friendly. So we see a lot of that. I was talking to a gentleman this morning that has a couple of properties, a 4-plex and a 10-plex here in the Portland area, and he's moving his properties down to Georgia. And in fact, done a lot of stuff in Georgia lately. Texas has been a hot spot for quite some time now. I think we did more people moving into Texas properties than we had ever seen in the last year. Of course, Florida has always been a kind of a hot spot. We see more people moving properties there from states like New York and New Jersey. When we had sales in New York and New Jersey in the past, it seemed like they were always reinvesting in those states again, but more and more of those people are moving into Florida now.
So when we put the company together in the early 90s, Oregon had some different laws with respect to what would happen. They actually, when we first opened doors, you probably remember, we had the one client that sued the State Department of Revenue because the state actually discriminated between residents and non-residents moving stuff out. Anyway, it led to some other legislation, which ultimately led to Oregon clawing back. So as Tom explained, there's a variety of reasons for people to move from one place to another. We've got, like he mentioned, the rent control issues. We also have a lot of people that sort of stems back down to when we got started, where people are thinking, well, gee, I at the end of the day, I'm going to pay the tax on disposition. I don't want to do an exchange, so I'll exchange out of Oregon into Washington, Nevada, Florida, Texas, someplace like that. Mm-hmm. And would you mind explaining to everyone out there why that maybe is not as an effective solution as it maybe used to be?
Well, we end up with people that will move, a lot of times they'll move from a property that has income tax into a state that from a state that does to a state that does not have income tax, like Washington. But and then they think that, well, down the road I sell that property, then I don't have to deal with the taxes that I had in Oregon, correct? And that's not the case, because the state will want you to continue to report back to them and let them know if you still have that property. Did you sell that property? If so, did you do another exchange? If not, then they're going to want their taxes. So they have these clawback provisions, and there's a number of states that do that. California, Oregon, to name a few. But it's you will end up having to pay those taxes, and again they ask for basically an accounting of where that money has gone. And have you sold? Did you exchange again or not? If you continue to exchange, you can certainly continue to defer those taxes. But upon a sale, the state's going to want their tax.
So it only applies when you're triggering a gain.
Yeah, exactly.
Got it. So with that said, I mean, another idea sort of along the same lines is people that want to give up an income property, maybe go buy a place that they ultimately convert into their primary residence. What happens in that scenario?
Yeah, so if they do that, there's no tax triggered upon the conversion. So if I were to sell a property and wanted to retire in Hawaii, and I bought an investment property there, and and maybe rented it out for a couple of years. If I decide I'm going to retire now and move into that property, you can certainly do so. There's no holding period requirement for these properties. So I can convert that property to my primary residence now. There's no tax upon that conversion. And in doing so, I can now convert my existing residence here into a rental property, and I will have up to 3 years to sell that property and still take my Section 121 primary residence exemption. So that's good. And if with respect to the primary residence exemption, it's 1997, I think, is when they created that $250,000-$500,000 exemption for single or married couple. A lot of people have well over that, and so you can have a situation where you have both a primary residence exemption and a 1031 if you've got gains that are over those exclusion amounts. Back to that conversion, though, if I move into Hawaii, then again, it's not a taxable event, and as long as I live there, fine. You don't expect, though, to be able to sell that property that it was a converted property from investment to primary. Don't expect that you're going to be able to sell that after 2 years of living there and be able to take that capital gains exemption as a primary residence now. The IRS has an amendment to 121 that deals with these converted properties, and it's kind of complicated, but they have this whole prorated figure of the time you've lived there versus time that property and previous properties were investment properties. And it doesn't work out in your favor unless you've lived there for quite some time.
So you might think you've got a great idea, you're going to get rid of the tax, but the government figured that out. We had a couple of years. We had from 97 to like around 2000 before they put the 5-year hold. And then they put the wonderful Housing Assistance Tax Act of 2008 in place, which shut it down. And then you're looking at gain attributable qualified versus non-qualified use periods.
Yeah, exactly. So there was a period of time there that people could do that. They buy an investment property through an exchange, rent it out for a while, move into it, live there for a couple of years, and take that exemption. And so people were able to do that for a little while. But like you said, the IRS caught on, and they're going to get you now.
So I think both these topics, we just covered 2 topics really in this segment. We're going to sign off in a second, but I think they're both examples of call and ask the questions. There's no such thing as a dumb question. And a lot of this stuff, there's not a black and white or maybe a hard yes or no on it. It's maybe how you're going to get to it. But over time, these opportunities that used to exist get stopped, and then we look for the next way around it, and then it's like the ants on the path, right? So
yeah, exactly. There's not a lot of ideas that are really original ideas, unfortunately.
Like old Ron used to say, right? Yeah. Very few new ideas. It's just repackaging of them. So thank you very much for that answer. Once again, David and Tom Moore, Equity Advantage, 1031exchange.com. Thank you. We'll be right back.